GM's $279 billion gamble is collapsing faster than anyone on Wall Street imagined. For years, the Detroit giant poured resources into cheaper factories overseas, betting that lower labor costs would keep profits soaring. But that wager is now ricocheting back across the border, threatening to gut America's once proud auto powerhouse and the hundreds of thousands of jobs tied to it. Once considered untouchable, GM's dominance now hangs by a thread, with internal reports warning of irreversible damage if decisive action isn't taken immediately. In a world where supply chains are weaponized and consumers demand more than just low prices, GM's old strategy is rapidly becoming its biggest liability. The company's very survival may come down to rebuilding what it dismantled a decade ago, yet the window for a turnaround is slamming shut. Stick with me, because by the end, you'll see why GM may have only months, not years, to undo the damage and how that ticking clock could reshape the entire U.S. auto future. One, the gamble that looked genius. When GM announced its aggressive offshoring plan in the early 2010s, analysts cheered. Shuttering plants in Ohio and Michigan, shifting production to Mexico and China, and trimming union payrolls slashed billions from operating costs. Share prices jumped, bonuses flowed, and executives boasted of a lean, global GM. For a moment, it looked brilliant. Each Silverado rolling out of Silao cost nearly $1,200 less than the same truck built in Flint. Investors loved the numbers. Consumers barely noticed the label inside the door until hometown dealerships began closing and Rust Belt towns lost their tax base. Hidden beneath the quarterly earnings was a growing void. Skills bleeding out of Midwestern communities and brand loyalty quietly eroding at home. Those losses would resurface just when GM could least afford them. But first, early warnings began to flicker, then rage. 2. The warning signs everyone ignored. Protests erupted outside shuttered U.S. plants, yet corporate headquarters brushed them off as noise. Meanwhile, rivals took a very different path. Toyota doubled down on Kentucky, Ford pumped billions into a new Tennessee EV hub, and Hyundai broke ground on its first U.S. battery plant. Politicians seized the contrast, labeling GM the poster child for corporate outsourcing, a phrase that stuck like tar in midterm attack ads. Washington then rewrote the rulebook, replacing NAFTA with USMCA. Suddenly, every engine, seat, and battery built south of the border faced stricter North American content mandates and the risk of punitive tariffs. Compliance costs rose overnight, clipping the very savings GM had chased abroad. Market share slipped a quiet 0.5% here, another there, until the unthinkable happened. Toyota outran GM in U.S. sales for the first time in 90 years. Inside Renaissance Center, leadership still believed the storm would pass, framing the slip as a temporary supply challenge. The storm, however, was only gathering strength, and every missed cue amplified the eventual impact. 3. Reality hits hard. By 2022, the EV revolution was in full sprint, and federal incentives demanded domestic batteries. GM's Ultium platform needed U.S.-made cells to qualify, but with most supply lines routed through Asia, the company faced billions in lost tax credits and a slower rollout than Tesla, Ford, and Rivian. Dealer lots told the story. Silverado EV pre-orders lagged, while the Ford Lightning racked up waitlists. Meanwhile, China, once GM's profit machine, turned hostile. Local champions BYD and SAIC flooded the market with cheaper, government-backed EVs, cutting GM's Chinese sales by nearly half within 2 years. The global hedge had failed on both ends, leaving Detroit exposed at home and abroad. Worse still, a cascade of software delays crippled GM's flagship Cruise autonomous program, draining cash just as regulators tightened oversight after high-profile crashes. Each setback compounded the last, transforming what looked like manageable headwinds into a Category 5 financial storm. Analysts who once modeled nonstop growth suddenly penciled in red ink, and the phrase terminal decline began to surface on earnings calls. For trapped between two fires, inside America, new rules demanded that 80% of critical battery minerals come from U.S. or free trade partner soil by 2027. Outside, Beijing's export controls on graphite and rare earth magnets tighten supplies, spiking costs for the offshore lines GM still relied on. Repatriating production sounded simple until accountants tallied the bill. Retooling U.S. plants, retraining a diminished workforce, and signing long-term contracts for domestic lithium worth north of $10 billion. Unions, newly empowered after landmark wins at Ford and Stellantis, insisted any comeback include higher wages and ironclad job guarantees, adding even more pressure to the balance sheet. Yet staying overseas risked disqualification from the very incentives that kept GM's EVs price competitive. Investors balked, credit rating agencies issued outlook downgrades, and whispers of a cash crunch started circling trading desks. For the first time since bankruptcy in 2009, analysts spoke the word collapse aloud. The critical moment arrived in early 2025 when suppliers, sensing blood, demanded payment in 30 days instead of 90. GM suddenly realized it wasn't just managing a production pivot, it was fighting a liquidity fire. 5. The collapse is already happening. January earnings showed a $4.1 billion swing from profit to loss, driven by recall costs, slowing Chinese demand, and a spike in tariff liabilities. GM tapped revolving credit, then quietly paused stock buybacks to conserve cash, an alarm bell for anyone who remembers 2008. Internal memos leaked. Without a rapid U.S. production pivot, incentive losses alone could hit $7 billion a year. Suppliers, fearing contagion, demanded faster payment terms, credit spreads widened, and banks hedged by raising rates on new GM debt. Wall Street's patience wore thin as activist investors called for a breakup, arguing that spinning off GM's EV line might salvage shareholder value while letting the legacy combustion business sink. The suggestion rattled workers and lawmakers alike, sparking bipartisan hearings on whether to intervene before a pillar of American industry crumbles. To calm markets, GM floated a partial spin-off of its autonomous driving unit, proof the company is now selling family silver to keep the lights on. Suddenly, the $279 billion machine looked vulnerable enough that lawmakers floated emergency tax breaks if GM promised a full manufacturing homecoming. Even that may be too late. Engineers warn that rebuilding a supply chain onshore takes 3 years. The company might have 12 months before lenders tighten the screws. And if financing dries up, a Chapter 11 repeat would send shockwaves through every state that still hosts a GM plant, hitting everything from steel mills in Indiana to semiconductor fabs in upstate New York. Final thoughts. GM's unraveling gamble is more than a corporate cautionary tale. It's a flashing red light for every boardroom calculating short-term savings over long-term resilience. Cheap labor abroad once looked irresistible, but today the real currency is strategic control at home. Public sentiment has turned sharply. Surveys show 68% of U.S. car buyers now prefer vehicles mostly made in America, up 20 points since 2018. That shift isn't just patriotic, it's practical. Supply chain shocks and geopolitical flare-ups have reminded consumers that reliability starts at home, and companies ignoring that lesson do so at their peril. Meanwhile, rivals like Ford and Toyota are rewriting the playbook, investing aggressively in American soil, creating jobs, and locking down supply lines GM can no longer afford to lose. Regulators, too, are watching. A new bipartisan proposal would deny federal fleet contracts to automakers importing more than 30% of critical components by 2028, a rule tailor-made to punish laggards. If GM can't execute a lightning-fast return to U.S. soil, its century-long reign could end in the very country where it began. The lesson echoes far beyond autos. Tech giants eyeing new chip fabs and apparel brands chasing ultra-cheap cotton are watching closely. Ultimately, this isn't just a story about an automaker, it's a test of whether American industry can relearn the value of roots. So, what do you think? Can Detroit's giant pull off a last-minute pivot, or are we witnessing the twilight of an American icon? Drop your take below, and if you found this breakdown eye-opening, hit like, subscribe, and ring the bell so you never miss the next big story shaking the auto world.